Welcome to the Road to 100 Million in Real Estate podcast, where you'll benefit from the opportunity to learn to become a skillful real estate investor. You'll get guidance from top industry producers, operators, and investors who are eager to help you learn from their proven strategies of success. Now to your host, Dorrance Constant.
Hey, welcome everyone to another episode of the Road to 100 Million in Real Estate podcast. I'm your host, Dorrance Constant. I've got another special guest on the show. We've got Reid Bennett in the house. Welcome, Reid.
Hey, Dorrance. I appreciate you having me on, man. I'm honored.
For sure. Great to have you. So, folks, just a little bit about Reid. Reid Bennett has a CCIM designation and serves as the National Council Chair of Multifamily Properties for SVM International and a Senior Vice President for SVM Chicago Commercial. And as a licensed managing broker for more than 20 years, he focused primarily on the sale of apartment communities across the Midwest, and also teams up with members of his council to serve clients across the country in over 150 markets. Reid prides himself on understanding the nuances and analysis of multiple unit apartment dwellings and low-income Section 8 and Section 42 communities. Again, Reid, welcome to the show.
I appreciate it, man. How are you? How you doing?
I'm fantastic. Another great day. Now, Reid, we typically start the show off in a very similar way. How has real estate impacted your life?
Oh, I mean, it tremendously. I mean, it's allowed me to view the world totally different, and just understanding the kind of the nuances within the real estate. Before I have a hard time placing a name with a face, but if I can place a person with the building, I never forget their name. My wife always makes fun of me for that. She has a very large family, and we've been married for almost 10 years, and I still don't know all of her family names. But if somebody I'd met them at their building, 15 years ago, I'll still remember them based on the fact that I connect the building with the face. So I can't imagine a better industry to be in when it's going great, and when it's not going great, I still can't imagine a better industry to be in, but I hope that answers your question.
Yeah, absolutely. And you've been in real estate now for the past 2 decades or so. So you've seen a lot happen, right? You were in it 2008, right? Also this, recent scare we've had, right, with COVID. Would love to hear more about your background, right? And then maybe talk a little bit more about the markets.
Sure. Well, I got my broker's license in 2001. So it's going to be 23 years ago, coming up here pretty soon. And, I initially just got my license because I wanted to learn and understand a little bit more about smaller units, 3 flats, 4 flats. My goal at that time was to simply just start buying those deals. Ended up starting to broker deals that were larger than that, and started in the neighborhoods of Chicago on the northwest side. When I started, it was a condominium craze. So as fast as I could find an apartment building, I could find a condo converter that was willing to buy the apartment building, put a bunch of money into it, de-pin the units, or actually pin the units separately, individually, and sell them off as condominiums. So for the first, I would say, 6 years of my career as a broker, I really didn't understand income and expenses. All I would do is go check out the units. I would see, can a 5-room, 2-bedroom unit be converted into a 3-bedroom unit, and could a 4-room, 1-bedroom unit be converted into a 2-bedroom? And I had at that time, it was one of the coolest tools in the world was a laser tape measure. So I would just go in and laser tape measure the units really quick. I would go out, write down all the dimensions and figure out exactly what the condo converters were looking for on the back end, and sell the apartment buildings then. And I've said this on a number of podcasts in the past. When I was 26, 27 years old, getting into this business, I literally believed that there would be no more apartment buildings. I thought every single apartment building, at least in Chicago, was going to be converted into condominiums, and I was going to sell myself out of a career. So I was worried about it at that time. Now over the last 5 years, people have been buying these condominium buildings and deconverting them back into apartments, which is just, it's wild. So I started doing, so once the condo market really came to a screeching halt during the the great financial crisis. Then I switched over to apartment complexes and started moving a lot of my clients that were willing to sell their apartment deal in Chicago and go out into the suburban markets, secondary and tertiary markets, and chase yield into those markets and buy apartment complexes. We've also gotten into low-income housing, selling deals that have a low-income housing tax credit component or a project-based Section 8 HAP contract. And then in 2013, I took over the National Council Chair for Multifamily, for our company here. And so throughout the council, we have about 266 members across the country that, my team here in Chicago teams up with many of the people in the council, and we work on deals all across the country. So we can service any client that's looking into any market across the country. And that's where we are today.
And when you say you service folks across the country in the market, what are the specific services that you offering folks?
Our primary business is multifamily brokerage. So we bring buyers and sellers of multifamily properties together, and we help owners sell and we help buyers buy.
Mm-hmm. Awesome.
It's a simple way to put it.
There you go. All right. Well, Reid, there's been so much change in the market, right? This time last year, there was so much up in the air, right? About where the market was heading, right? So fast forward a year later, how would you compare what you've seen in the market last year this time versus what you're seeing in the market this year this time in terms of folks buying, selling, what's available in the market, et cetera?
It is a complete 180. It's night and day compared to what it was. The absolute peak of the multifamily market was March of 2022. And that's when the Fed started they started their aggressive interest rate hikes in March of 2022. And I think we've had 13. So it's been over 500 basis points of interest rate hikes from the Fed. And to put it into perspective, it typically, talking and listening to a number of different economists going back 40 years of data, it typically will take the market 8 months to absorb a 50 basis point increase from the Fed. Okay. So we've had over 500 basis point increases from the Fed in a year and a half. So we haven't seen, what the eventual results of these drastic increases have been. There's no business on the planet like commercial real estate that has been affected by, the Fed raising rates like this. Where we, about a year and a half ago, we were submitting offers on multifamily assets with, $1 million hard day one, no due diligence days, no, don't even need documents, just sign the contract. We're already hard on it.
Wow.
And then also when we're marketing deals, we'd have, 24, 25, 26 written offers coming in on a particular property. And a majority of those had hard earnest money day one. It was a feeding frenzy. And we called it, fish were jumping in the boat, during that time period. And now, you not only need to find the fish, you need to know exactly what lure to put on and exactly how to put this into a particular box in order to make deals happen right now. Because deal volume across the country in the multifamily space is down, 63 to 73% from where it was at the peak of the market in March of 2022.
Absolutely. So back then, a year or so ago, it was just simple, very easy for a buyer or seller just to put something on the market and would have multiple offers, right? Without due diligence, and folks were competing. But now what you're seeing is the market's softer. The sellers have to come up with, concessions, things of that sort in order to actually get buyers to really, if you was call, bite, right?
Yeah. I mean, the current debt markets have made such an adjustment to what can actually happen. So buyers are much more nimble than sellers. Sellers still, are thinking that, well, I've had all these, sub 3% cap rate offers, okay, maybe the market softened a little bit. Maybe I'm going to get a 4 cap now. when in reality, it might be a 7.5 cap on their property. So buyers are much more nimble because they're the ones that are sourcing the debt. They're the ones that are seeking the capital. They are understanding exactly what their debt sources are, how they're underwriting the deals. They're able to pivot very quickly into what they're writing. The sellers, I think we still have about probably 7, 8, 9 months before the sellers realize what I could have gotten in March of 2022 is much different than what the current market is right now. And that's what we're doing. We're spending a majority of our time saying, here's the pricing that you want. Let me take that pricing. Let me underwrite it. Let's assume, even the most aggressive net operating income that we can on your property currently. And now let's run it through the debt, kind of a debt calculation as to what it's going to hit. We just did this a couple of weeks ago with a seller in a market that we've sold over 27 complexes. They said, look, let's get these two on the market right now. We went through the numbers. We said, look, with the number that you want to hit, this is going to be a 0.8% cash on cash return and a 0.75% debt, or a 0.75 debt coverage ratio.
Mm-hmm.
And, once you see those numbers, you realize, okay, here's what we need. Here's what needs to happen. Either the rates need to come down significantly, or we need to increase our NOI significantly. And, one of my favorite sources of information is Yardi Matrix, and they recently had their updates with the market. And one of the things that stuck with me from a recent podcast that they had was, for every 35 basis points the actual interest rate rises, you have to increase the NOI on a property by 4% to hit the same price.
Mm.
And I mean, so then when the actual rates have increased significantly more than 35 basis points, you're ending up having to increase your NOI 30 or 40%, which is virtually impossible, especially with the upward pressure on expenses.
Right.
So it's a very strange market that we're in right now, and it's that's just where we are. That's why we have a huge cavern from the bid versus the ask pricing right now.
Right. Well, since you're representing sellers as well, right?
Yep.
Who do you think? How would you categorize the sellers that are most vulnerable right now, considering so many of the changes that have happened in the market? And what are a lot of those circumstances that they're in that they may have to sell?
Sure. The most vulnerable sellers are those that purchased with short-term debt or bridge debt, that they now are going to have to refinance that debt, and it's quadruple what they thought that it would be at this point. So, and a lot of the deals are no longer going to be penciling out, even though, and by the way, the groups that purchased with short-term bridge debt also had very aggressive underwriting, both from an income standpoint, raising rents. We're going to raise the rents, $250 a unit across the board. We're going to, potentially reduce our expenses. That's not happening. The inflationary pressures on expenses are wiping out virtually every rental increase that they were putting into their underwriting models. From insurance expenses that are going up about 19% across the country. Some places they're going up 70%. Real estate taxes are haven't caught up to what the 2021 and 2022 pricing was at that point. So that's while you have these huge pressure, like expense pressures on the increase, the metrics are still positive on the income. Because what this market has also done is a lot of the would-be home buyers that would be leaving the rental market and going to buy a home are finding that the home prices haven't come down, but the 30-year mortgage has gone up to almost 8%.
Right.
So what's happening is the reason that the home prices haven't come down is everybody that has a 3% or sub 3% 30-year fixed rate on their home is not selling their home to go into a new home to pay an 8%, almost an 8% mortgage on a higher priced home. So it's, the inventory, there's virtually zero inventory in the homes. The home prices have not come down, so the metrics have remained high for the multifamily space, which has been another problem for the sellers. They're saying, why would I sell my property when I'm raising my rents $100, $150, $200 a unit, even on the renewals, when I could just simply keep this property and it's cash flowing well? I'm not going to accept the discount, which is what the market is looking for, a discount at this point.
Right. And what strategies have you been seeing in the marketplace for folks on the buy side, to go out there and actually find good deals that make sense, even for maybe even some of the more vulnerable, sellers?
Sure. I believe there are three different types of properties can transact in this market. The first is going to be a property that has favorable assumable debt. The challenge with that is the loan to value ratio has to be such that it makes sense for a buyer to come in and assume that loan. You can't have a seller that says, look, I have a $5 million assumable loan at this fantastic rate with plenty of term, but I want 15 million for my deal. Nobody's coming in with $10 million to buy a $5 million loan, even if it has, a 1%, interest rate. It doesn't matter.
Mm-hmm.
So with assumable financing, as long as they juiced up the loan and you have, 60 to 70% plus LTV, loan to value, then it makes sense. And then you can't have 1 or 2 or 3 years left on that term. You have to have a significant amount of term left for that to make sense as well. The second kind of deal we see getting across the finish line are going to be deals where the seller has enough equity in the property that they can carry paper or, sell the loan and be the bank. In that instance, they can get a much more aggressive price if they're willing to offer the terms to the seller that equate to, 2021, 2022 terms of a mortgage. And then the third, obviously, is going to be distressed, where, these deals are sold at a drastic discount. The thing is, we're not seeing that at this point. In fact, we're doing our first tour of a number of different assets that a receiver has. We're not seeing a lot of these deals at this point yet, because a lot of the deals, even if a lender is considering taking them back, the metrics are so strong on that asset that they can typically have a borrower step in, or they're going to do what they did back in 2008, 9, and 10, which is that whole extend and pretend, where they just say, all right, we don't want to be, because lenders don't want to get into the chain of title.
Mm-hmm.
So they will say, look, you continue to operate the property, it's cash flowing at the current debt. Let's just extend this loan and extend the situation and just kind of pretend that this isn't happening. We're going to see that, I think, a lot with loans that, the property metrics are still there, the rent's still coming in, and you have a good operator that's in the property.
Gotcha. So. And for those folks who are looking to, find some of these types of opportunities, I know you're across the country. Are there certain markets you think are more prime for investors as buyers on the buy side?
It depends on which kind of situation you're in. So a lot of the Sun Belt region that has been the hottest over the last 5 years, the challenge with a lot of those markets is they have a lot of product coming on the market as well. I'm based in Chicago here, and my team and I work a lot of the Midwestern markets. We track every single existing property in Illinois, Indiana, Wisconsin, and Iowa from 100 units and above. I'm biased on the Midwestern markets. I think they're the strongest markets. We seem like we're a little more recession proof because we don't have huge swings like we see on the coasts and the Sun Belt region as far as appreciation. It's kind of like a steady cash flow market in many of our Midwest markets. But that's not to say that we didn't see a huge, influx of capital that came in from the coast into our markets. We were selling deals sub 3 caps in certain circumstances that were, 1985 vintage builds that had a ton of value add associated with them. So it depends on the market. It depends on the product, But to me, there's always sellers in every single market. And we call them the 3 or 4 Ds, depending on how you want to, structure that. And that's, there's disease, there's divorce, there's distress, and there's always, and by divorce, I mean, that can be a number of different things. That can be familial. That can also be a partnership divorce. We see those all the time where, 2 different or 3 different partners have different concepts of how they want to run a multifamily asset. And they're just going to be separating, going their separate ways, no matter what kind of market it is. They're going to sell and take whatever they can get. So
thanks for that. And is there, you're full of knowledge, and we appreciate that. Are there certain publications, anything that you're paying attention to that's helping you keep up to date on the market and what's happening?
There are a number of things. I watch Yardi Matrix has a fantastic platform when they track a lot of the happenings within the multifamily space. We also have Real Capital Analytics that we track a lot of the data of what's happening in the markets, and they do a fantastic job of updating the trends, both from a deal volume, cap rate. They also are tracking everything that's coming to market as far as the development. There's a number of things. I'm happy to share it with you that you can post, for your listeners moving forward.
Awesome. Well, we're coming to the end of our show. Got a couple more questions for you. Is there anything that you're working on that you're excited about that you think our audience should know?
We are actually, what we're doing right now is we're sharing a lot of information with a lot of different people. So we're excited to share a lot of the knowledge that we've built. And so we built a database that tracks every single apartment complex across the Midwestern markets and many other markets around the country. And we're sharing information right now, both with buyers and sellers of assets. We're also sharing it with lenders. So if a lender has a particular property that they're looking to try to figure out what to do with in this kind of a crazy market, we're happy to share information, give broker opinions of value to help them make an informed decision on moving forward. So we're really happy with that. What we're also doing is we're building up our presence on LinkedIn and Twitter, which is where I think we connected, because right now it seems like those 2 platforms, as far as sharing information and sharing content, have been really blowing up. And so it's been fun to meet people like you and a lot of the other groups that I never would have known about had it not been for the interaction of social media, both on LinkedIn and Twitter.
Okay, great. And if there's one thing that if you could go back and wave a magic wand and change in your career, what would it be and why?
It would be to partner up with people, get a mentor earlier that was doing exactly what I wanted to do in the business, and get that way earlier. And then also, I would hire a business coach way earlier. I hired a real estate brokerage coach, after I was in the business for 18 years and it quadrupled my income within about 2-year period. So I would have done that way earlier on in my career, and then had that kind of a community from a mentor or a coaching perspective much earlier on in my career.
Fantastic. Great advice. Yeah. It's interesting that, a coach or a mentor can save you so much time, right? By offering you strategies, especially since if they've been there, done that, and even better, have been there, done that, and brought folks along with them. I'm a big advocate of coaches and mentors.
Yeah. If you really think about it, there's probably not one original idea that you could come up with right now in the multifamily or real estate space that a mentor hasn't already made the mistakes, perfected a system, or started the system that you could build upon moving forward, and then adjust it according to ChatGPT or LinkedIn or Twitter or whatever is happening now. But it's all, the fundamentals are all the same as they were 20 years ago.
Right. Absolutely. And I'm sure folks are going to want to connect with you, Reid. What are the best ways for them to reach out to you?
So they can reach out to me on LinkedIn and Twitter at this point. If you want to get an immediate response, you can also call my cell phone. If you want me to share it with you now, I can do that.
Go for it.
My cell is 773-251-7342. And my email is reid.bennett@svn.com. That's REID, period, BENNETT @SVN.com.
All right, awesome. Well, Reid, it was a pleasure having you on the show today. Thanks for dropping so many gems and giving us an update on what's happening here in the market. We really appreciate you and I hope to have you back on the show soon.
Anytime. I appreciate it. Nice talking with you.
We trust that you enjoyed today's show. Visit archcapital.ventures to learn more about how you can leverage real estate investing to improve your life through passive income, financial freedom, and generational wealth.